All right, Roth IRA versus traditional IRA. What the hell is the difference and what one should you do? All right, let's break it down here, make sure everybody understands the differences between a Roth IRA and a traditional IRA so you can decide which one you should be doing in your specific situation. All right, now let's go over the traditional IRA first. Now, in a traditional IRA, when you put money in, you get a tax deduction. All right, that's pretty nice. You can put $6,500 in a traditional IRA or actually a Roth IRA. When I put my $6,500 into a traditional IRA, I get a $6,500 tax deduction. And that goes up to $7,000 in 2024, a $500 increase, pretty exciting, I know. Now, but that tax deduction is cool, that's gonna reduce my taxable income and I'm gonna save money. Okay, I get to save money now on taxes because I did a traditional IRA. So I get a tax deduction on the way in. Now, as the money grows in the traditional IRA, let's say I did 10 years of contributions, $6,500, I've got $65,000 of contributions, but my account's worth $200,000 because I've had investment returns and gains, I've sold asset, I've had investment income come in. The cool thing about that is there's no tax as it's growing. So I got no tax on the growth. All right, that's pretty cool. No tax as I grow the investment. Now, the downside to the traditional account, and what many people think is the reason not to do the traditional account and why people will do a Roth IRA instead, is on the way out, as you start pulling money out of the traditional IRA, there's tax. So they hooked me on the front end with a tax deduction to put money in, and I love that now because I got to save tax now. I got to defer taxes I'm making money because I'm not paying taxes I'm growing the account. But when I start pulling the money out at retirement, when you're 59 and a half, that's the age you can start pulling money out of a traditional IRA, you're going to pay tax on the way out. And it's whatever tax bracket you are at in retirement. All right, now let's go over the Roth IRA. The Roth IRA is awesome, but there's some catches to it too. Now in the Roth, when I put money in a Roth IRA, no tax deduction. If I put $6,500 in my Roth IRA for 2023, $7,000 in for 2024, the federal government's like, cool, good for you. No tax deduction though, okay? So it's not helping me save taxes today. Now I get the same no taxes I'm growing the account, okay? As I'm investing and it's making money, I got investment income coming in, I'm selling assets for gain, it's not going on my 1040, I'm not paying any taxes I'm growing the account. And that's a powerful concept with both the traditional and the Roth, and this is one of the things they share in common. As you're growing the account, you get to reinvest every dollar. You're not paying 1/3 to the federal government and 10% to the state, as you get to reinvest 60% of your gains. Every dollar gets to be reinvested, and so it's faster to grow your account. You think of the ability of compounding your investments over 10, 20, 30 years, whatever your investment horizon is for your IRA, that's a huge perk, okay? So traditionals and Roth both get that benefit. Now the cool thing about the Roth IRA is tax-free on the way out. There is no tax on the way out. When you hit retirement plan age of 59 and a half, you can start pulling money out of the Roth IRA, zero tax. So a lot of people refer to the Roth as the tax-free account and the traditional as the tax-deferred account. Now I gotta defer my taxes in the traditional, I'm gonna pay it later, and they suckered me in by giving me a tax deduction now, right? Now the way this works for IRAs is similar for 401ks. If you've got a traditional 401k, you got a tax deduction to put it in, it's growing, no tax on the growth, but you do pay tax on the way out. If you got a Roth 401k, it's the same thing as the Roth IRA. You didn't get a tax deduction to put your money in your Roth 401k, there's no taxes you're growing the account, and it's tax-free on the way out, okay? So that's how traditional versus Roth works. Now, if you're a higher income earner, tax deductions are more valuable. You might be like, all right, Matt, I'm in the highest tax bracket. I'm in California too, so I'm paying 40% in taxes. If I can get a $6,500 tax deduction, that might save me $3,000 in taxes on my taxes. That's a huge savings because I'm in a high tax bracket. On the other hand, if I'm doing a Roth account, I get no tax deduction at all. So sometimes people in higher tax brackets get sucked into the traditional account, and I say that in a good way because you are getting tax deductions now, but it's more bang for your buck. So a lot of people say it's a no-brainer for a Roth on lower or middle income earners because the tax deduction isn't as valuable. They might be in a 20% state tax bracket, and maybe they're in a, they might be in a 20% federal tax bracket, in a 5% state income tax bracket. It's not as big of a tax savings for them to make a traditional retirement plan. It's not as much tax savings for them to make a traditional contribution. The Roth is the way to go then for lower middle income earners. Now, I will say this, most of my high income earners that are smart and savvy use Roth accounts. Okay, the largest Roth IRA is Peter Thiel. It's got a $6 billion Roth IRA. I have clients with 100 million plus Roth IRAs. Okay, the reason they did that is because they had amazing investments to make in private companies and real estate, doing self-directed IRAs, which we do every day at Directed IRA, our company. And they know this is a tool for tax-free growth to make amazing investments to pull it out totally tax-free later at retirement. Now, if I were you, I would go with the Roth IRA here. Okay, I've always been a Roth fan, but let me give an example here to help illustrate this. Let's say you could have $1 million traditional IRA or a $700,000 Roth IRA. You're 60 years old, you get to pick which one to take into retirement. I'm gonna go with the $700,000 Roth IRA. A lot of people are like, Matt, you're crazy. You're leaving 300 grand on the table. No. I'm being smart. The $1 million traditional IRA, let's say you're in a 30% federal tax bracket, 5% state, you're in a total tax of 35%. As you're pulling that $1 million out, you're paying 35% of that, 350 grand in taxes. You're only gonna get 650,000 of it at the end of the day. On the other hand, that 700,000 Roth IRA, that's coming out 100% tax-free, no state, no federal income tax. So at the end of the day, the 700,000 Roth IRA is more valuable to you than a $1 million traditional IRA. Now the same rules apply here for a 401k between having a 700,000 Roth 401k and a $1 million traditional 401k. It's the same rules there, no tax on the Roth, tax on the traditional. Now, everybody's situation is different though. We're helping clients around the country decide what to do, how to save taxes, how to plan. Our law firm, KQS Lawyers, and there'll be clients use IRAs, traditional IRAs, Roth IRAs, to self-direct and invest in assets they know and love to have the $1 million, $10 million, $100 million, maybe even the $1 billion Roth IRA like Peter Thiel. Please subscribe to my channel. I'm bringing more tips about how to take control of your retirement, build wealth, save taxes, protect your assets. We'll see you next time.